Welcome back. I'm Greg Lisko with Iron Point Financial, and we're happy that you've come through this far into the series. Section 2 we're going to call Mutual Fund 2.0, betterly known or actually known as Unit Investment Trusts. So in the last video I mentioned that the world has changed quite a bit since the 1930s, and the Unit Investment Trust is one of those things that has changed in the investment world to keep up with technology. So what are the big differences? Well, the big differences are we have before we go to the differences, let's stick with the similarities. The similarities between a unit investment trust and a mutual fund are that they are still professionally put together investment tools. Right? You can still pick from a wide variety of funds or unit investment trusts for specific sectors of the market, right? And those are the big similarities. What really separates them is their differences. Their differences, while a mutual fund is actively managed, so you've got a team behind it, buying and selling, maybe on a daily basis, which runs up cost, right? You've got labor and expenses due to trading. A unit investment trust does not have that. Now they are dynamically, actively, professionally put together in a very rules-based, quantitative way. I love to be on the side of math, right? I want to know that we have a reasoning besides a gut feeling for putting something together. So a unit investment trust, while professionally put together, is not traded actively once it's put together. It has a start date and an end date. So typically between 15 and 24 months, right? So we have our quantitative analysis, our screen. The math tells us what we should be holding at that point, and we're going to hold it for the lifetime. Then it matures. All of the positions are sold, the math is redone, second portfolio is then put together. Now what does that now enable us to do? We have every 15, 18, 24 months, we have to talk, right? So we're gonna reanalyze where are we in the market cycle, what's going on, what is the best place to be right now? And then we have the opportunity to pick the corresponding trust to fit where we are macroeconomically right now, okay? One of the other major differences in a unit trust is that you own your own cost basis, right? Remember in the mutual fund section where we said, you may only be in there a day and then you could experience a two-digit capital gains distribution, right? Well, you only had it a day. That wasn't your cost basis, but they're buying and selling on your behalf inside the fund, creates capital gains. Now, a unit trust, if I'm going to put my $1,000 in, I am there. The units inside, the shares of stock or closed-end, whatever comprises that trust, I own those shares individually, right? So I own my own cost basis. And where does that really become important? Well, when things go crazy, right? You get into that down cycle, you don't have to worry about everybody else panicking and creating an issue for the block, for the whole fund, because it doesn't affect you, right? You still own your shares. So it's a really interesting, systematic, quantitative way to invest that we talk a lot about needing a plan and working that plan. Well, this is one way that we can systematically approach investing, and it's a really interesting way to do it. We'll see you in the next video.